Welcome to our channel where we unravel the complexities of the stock market. Before we dive in, please hit the like and subscribe button to stay updated with our latest content. Today, we're going on a journey that will open up the world of stock trading for you. We'll be breaking down some of the most vital concepts that every investor, whether seasoned or new, should comprehend. We'll be discussing bid and ask, the backbone of any trade. We'll explore market cap, a key determinant of a company's size. We'll delve into volume, a measure of market activity. We'll interpret the 52-week high and low, a snapshot of a stock's yearly performance. We'll understand beta, a stock's volatility in comparison to the market. Lastly, we'll examine overvalued and undervalued stocks, the crucial elements to stock picking. Now to start with, we'll discuss bid and ask in the stock market. In the world of stocks, bid and ask play an important role. Think of these terms as the heartbeat of stock trading, pulsating with every transaction that takes place. Let's break it down. The bid is essentially the highest price that a buyer is prepared to pay for a particular stock. On the flip side, the ask is the lowest price at which a seller is willing to part with their stock. These two prices are pivotal in setting the stage for a transaction to occur. Imagine a marketplace bustling with buyers and sellers. A buyer eager to purchase a stock will look at the ask price to determine how much they need to shell out. Conversely, a seller seeking to unload their stock will eye the bid price to gauge how much they can pocket in return. The interaction between bid and ask prices impacts the trading process significantly. It's a game of patience, strategy, and negotiation. Buyers aim to buy low, sellers aim to sell high. The difference between the bid and ask prices, known as the spread, reflects the supply and demand of a stock. A smaller spread indicates a well-balanced market, while a larger spread can suggest volatility. Understanding the dance between bid and ask prices can provide valuable insights into the stock market's dynamics. It's a key component of informed trading, helping you make smarter financial decisions. Next, let's move on to the concept of market cap. When investing, one of the key metrics to consider is the market cap. Now you might be asking, what exactly is market cap? Good question. Market cap, or market capitalization, is the total market value of a company's outstanding shares of stock. It's like a price tag that the market puts on a company. To calculate market cap, we simply multiply the current share price by the total number of outstanding shares. For instance, if a company has 1 million outstanding shares priced at $10 each, the market cap would be $10 million. So, why is market cap important, you might ask? Well, it provides an indicator of a company's size and growth potential. It's a quick way to gauge the value of a company in the eyes of the market. But remember, it's not the only factor to consider. A large market cap often indicates a well-established company with a history of producing reliable returns. On the other hand, a smaller market cap might belong to a newer, potentially riskier company, but with a higher growth potential. In essence, market cap gives you a snapshot of a company's worth, helping you make informed decisions about where to invest your money. But it's not the only piece of the puzzle. Understanding volume is equally important, which is what we will discuss next. So, stay tuned as we continue to demystify the exciting world of stock market investing. Volume is a crucial factor in stock trading. Let's break it down. When we talk about volume in the stock market, we're referring to the number of shares that change hands during a given period. It's like a heartbeat monitor for the market, pulsing with each buy and sell order. Now, what does volume tell us? It's all about liquidity and activity. Imagine you're at a bustling market. The more people there are buying and selling, the easier it is for you to jump in and make a trade. That's liquidity. A stock with high volume has high liquidity, making it easier to buy or sell without causing a significant price change. Activity, on the other hand, is like the buzz in the market. A sudden spike in volume means there's a lot of buzz around a particular stock. Maybe there's breaking news, or perhaps the company just released its quarterly earnings. Whatever the case, a high volume indicates strong investor interest and active trading. But here's the kicker. Volume alone doesn't tell you whether the stock price will go up or down. It's a piece of the puzzle, yes, but it's not the whole picture. You have to consider it alongside other factors like price trends, market sentiment, and fundamental analysis. Remember, volume gives you a glimpse into the market's heartbeat. It's a key tool in your trading toolbox, helping you understand the liquidity and activity of a stock. Now let's delve into the concept of 52-week high and 52-week low. In stock trading, the 52-week high and 52-week low refer to the peak and trough prices of a stock within the past year. They're not just financial vernacular, They're key indicators of a stock's performance range. But remember, the 52-week high and 52-week low shouldn't be looked at in isolation. They exist in a broader financial context, including the company's earnings, market conditions, and sector trends. Now let's look at beta. Beta is a measure of a stock's volatility in relation to the market. Now, when we speak of beta, we're talking about a stock's risk in relation to the overall market. It's a numerical representation of how a stock might react to fluctuations in the market. In simpler terms, think of beta as the tendency of a stock's returns to respond to swings in the market. When a stock has a beta of 1, it signifies that the stock's price will move with the market. If the beta is less than 1, it indicates that the stock will be less volatile than the market. Conversely, a beta greater than 1 suggests that the stock will be more volatile. So how can you as an investor use beta? Well, if you're risk-averse, you might lean towards stocks with a beta less than 1, as their prices are less likely to experience severe fluctuations. On the other hand, if you're open to taking more risks for potentially higher returns, you might find stocks with a beta greater than 1 more appealing. However, remember that beta is just one measure of risk, and should not be the sole factor in making investment decisions. It's important to consider other factors such as the company's fundamentals, industry trends, and economic indicators. Closing. Lastly, let's discuss overvalued versus undervalued stocks. Determining whether a stock is overvalued or undervalued can be tricky. But let's untangle the knot. When we say a stock is overvalued, we mean it's trading at a price higher than its intrinsic value. Intrinsic value? That's the perceived true value of a stock, based on all aspects of the business and its prospects for future growth. On the flip side, an undervalued stock is one that's selling at a price lower than its intrinsic value. It's like finding a hidden gem in a thrift shop. The price tag doesn't reflect its true worth. Now, how can these concepts help in making informed investment decisions? Well, if you perceive a stock to be overvalued, you might think twice before buying. It's like being at an auction where an item is going for a higher price than it's worth. You'd probably hold on to your bid paddle, right? Conversely, spotting an undervalued stock can be like finding a treasure chest. It's an opportunity to buy shares at a discount, with the hope that the market will eventually recognize the stock's true value, leading to potential profits. But remember, these terms are subjective and are based on estimations and predictions. There's no foolproof method to determine the intrinsic value of a stock. It's all about doing your research, staying informed, and of course, a little bit of luck. That concludes our discussion for today. We've covered a lot of ground today. We've embarked on a journey into the heart of the stock market, demystifying complex concepts and making them more accessible. We've broken down the mechanics of bid and ask, helping you understand how these two elements drive the stock market. We've delved into market cap, illustrating its significance as a measure of a company's value. We've explored the importance of volume in stock trading, shedding light on its role in identifying market trends. We've interpreted the 52-week high and low, a crucial tool for assessing a stock's performance over a year. We've unraveled the concept of beta, demonstrating its importance in gauging a stock's volatility. And finally, we've compared overvalued versus undervalued stocks, guiding you in making well-informed investment decisions. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to our channel for more insightful content. Until next time, happy investing.